You guys thought that was it for Rezolve? Stock's up 15% today, currently $5.82 per share. Man, you just can't get through to some people. Here in today's episode, we're going to go over what's going on with Rezolve. The news that is coming out today. There's a couple different pieces of news. But if you don't get it by this point, yeah, just like invest in the S&P. Rezolve came out with blowout numbers and guidance. That's the only thing that mattered. The stock sold off yesterday. It was up about 22%. It closed up a little over 1%. People were like, what the F happened? There was a lot of residual sellers. There's a lot of selling pressure yesterday for somebody that maybe bought in the sevens and was expecting a 100% rally on good numbers and said, I'll just cut my loss in the sixes. That's what I mean by residual selling. Well, that is largely over with today. And those residual sellers are looking stupid, for a lack of a better word. I said yesterday, just wait till the analyst price targets come out. Just wait for that. That'll show you just how good the numbers are. Well, they're coming out, and they're incredible. So we have a lot of news to get into today. We're going to look at the option activity, what the short sellers are doing, and much more. Hit the like button, subscribe to the channel if you have not done so already. Check out that link down below in the description of today's episode. I have went out and bought a new under the radar AI stock that I think you would like. Link down below in the description of today's episode. But let's get started. So we have this Rezolve price target raised to $15 from the Maxim Group. Okay, this is a 12-month price target. Keep that in mind. Basically a 3x from today. They say that they raised their price target, Tom Forte, to $15 per share from $10 per share while maintaining a buy rating. The analyst commented, quote, yesterday morning, Rezolve AI reported first half 2025 results with both revenue and adjusted EBITDA ahead of expectations as the company begins to ramp annualized recurring revenue, ARR, and revenue. Management updated its ARR progress and outlook, highlighting acceleration from 70 million across 50 customers in June 2025 to 90 million with more than 100 customers in September 2025, raised guidance to a minimum of 150 million ARR by December 2025 from 100 million and introduced 2026 ARR guidance of 500 million by the end of 2026. We believe this progress underscores one of our core bullish arguments, Rezolve's ability to capitalize on a hot AI market by forging and monetizing strategic partnerships and target acquisitions, leveraging the client networks of partners and acquiring businesses and upselling into the broader Rezolve AI suite. As Rezolve's customer base grows and revenue momentum builds, we are materially raising our revenue forecast while narrowing adjusted EBITDA losses for 2025 and 2026. In particular, we raised our revenue estimates for 2025 to 41.3 million from 20 million, for 2026 to 200 million from 75 million, and introduce a 2027 estimate of 563 million with adjusted EBITDA turning positive in 2027. We reiterate our buy rating, and due to our significantly higher estimates, we increase our price target to $15 from $10 based on our 10-year DCF analysis. Well, look at that. It took one day for analysts to come out and give a new price target. And this, to me, is assuming that we don't go through an AI super cycle in markets, right? I believe into the end of the year, into next year, you could see AI valuations explode from here. Now, on a DCF model, that's modeling actual numbers, right? That's not necessarily incorporating a multiple increase, okay? If we were to get a multiple increase to Rezolve or other AI stocks as well in the software space, you could see Rezolve substantially higher than $15 per share, but I think that's a reasonably conservative target over the next 12 months. That would be almost a 3x from current levels. Now, H.C. Wainwright maintained their buy rating. They raised their price target to $10 today, which is an increase of 11.1% from $9 per share, with the current price, as they posted that, was $5.06 with upside of 97.6% versus the price target. They do their key takeaways here. First half revenue above the estimates, raised guidance 50% from their prior target, already secured 90 million ARR with a strong pipeline visibility, announced 2026 ARR exit rate of 500 million. They say growth drivers, M&A, internal sales expansion, Google and Microsoft partnerships, willing to trade near-term profitability for growth, expects consensus 2026 estimates to rise. Near-term share support from business updates, acquisitions, and new contracts. Analyst sentiment says bullish, strong ARR visibility and pipeline support, long-term upside. Analyst comments. He says, prior to market open on October 1st, Rezolve AI Limited reported better than expected first half 2025 revenue, 6.3 million versus our 5 million estimate, and provided a new 150 million ARR target for 2025. The 50% increase in target is driven by a combination of 90 million in secured ARR to date, as well as the current pipeline strength. These quarters through the year, we believe the company has strong visibility into its full year, giving us confidence in management's ability to meet this target. In addition, the company provided an initial ARR exit rate for 2026 as $500 million. Future revenue growth should be driven by a combination of M&A, growing internal sales capabilities, and new customer acquisitions through the company's hyperscaler partners, Google and Microsoft. While timing around future revenue will be largely dependent on deployment schedules and M&A, we believe updated revenue targets suggest consensus estimates for 2026 are likely to increase in the coming days. That means like analysts and investors are going to start raising their estimates. As revenue scales, the path to profitability becomes clearer. Though we believe the company is willing to trade near-term profitability for revenue growth, given current opportunities, while investors are unlikely to see material revenue improvement until the company reports a full year result in the spring of 2026, we believe additional business updates, acquisition announcements, and new contracts should support share appreciation near term. We are increasing our price target to $10 from $9 on higher 2026 revenue, but see more material share appreciation longer term if the company can execute against current targets. We recommend investors continue to accumulate Rezolve shares as operating results improve and new acquisitions are announced. We maintain our buy rating. H.C. Wainwright says we recommend clients accumulate shares. And you got some of the retail folks yesterday and over the past week or so scared shitless. I get it. Short reports come out on easy targets and it's like, what the hell happened, right? Rezolve was an easy short seller target, but those days are behind us now. The residual sellers took place yesterday. And as buyers begin to step in today and accumulate the stock and have analysts' opinions coming out, not a single analyst, by the way, has said anything about the short report. Clearly, they don't believe the report. Now you're entering a new phase again for Rezolve. And honestly, it looks pretty good even from the low that we had 2 days ago, making some solid improvements from the low of the day on September 30th at $4.70. The stock is up well over $1 from that low and looks to be on a path back into the sixes. The stock is currently $5.83 per share, but we can get back above $6.50. That's where more of that upside comes into play. Grizzly Research today actually posted an X post. This was actually yesterday at 1:50 p.m. Says, we are short Rezolve AI after weeks of investigation. We conclude that the business is nothing more than smoke and mirrors and that today's news is simply another promotional piece. Yikes, what a bad time to go short. What a bad firm. To short a company like Rezolve after that kind of guidance on emotions. Yeah, that's rough. Now, we don't have any interesting trades in the options activity today from hedge funds and institutions. At least nothing is getting flagged, but it's still very bullish when you look out to the chain. October 3rd was a little bit more neutral. You have open interest of 60% calls and 40% puts, as people were obviously nervous, hedging a little bit. But even when you look out next week, open interest is 83% calls, 17% puts. The week after that, 83.66% calls, 17.36% puts. The week after that, 86.66% calls, 13.34% puts. Even the volume today, 93.3% calls, 6.71% puts. People are, realizing that these short reports meant nothing to begin with. Now, short interest has kind of collapsed as well. Again, I expect that Fuzzy Panda likely covered their short position. If they were smart, that's what they would have done. Short interest of free float fell from about 10% yesterday to 7.23% today. The dollar amount sold short in the stock down to 58.64%. Cost to borrow fees minimum 28%. Cost to borrow average 40%. Cost to borrow max 45%. Utilization at 67% with a short score of 71.28. You'd have to imagine some of today's price action as well. Stock currently up 16%. At the time of recording this video is likely due to some short sellers opting to cover on their short positions as well. Now, I do want to share with you broader market news today as well, what's going on in the broader markets. But first, I want to share my position. Right before earnings, I did buy another 2,000 shares, 1,000 of which in this portfolio, which brought my average cost up from $2.80 to $2.96. Current market value, $82,000, currently up 97.5%, up about $41,000. I still own the Rezolve 250 calls for February 20th, 2026. I do think we are shaping up to have a pretty aggressive end of the year rally, but when I do sell, it's going to be the options first. I really don't have plans in selling the stock under $20. Again, I'm kind of trying to buy a business. I'm trying to buy a restaurant out. And, if I have to sell the stock, I will. Like, I'm not saying I will not sell under 20, but we'll see what happens with that. That's totally separate from the thesis in the company. In this portfolio, currently have 12,000 shares. Again, average cost basis $2.97 a share. Current market value $70,200. Currently up $34,600, or about 97.5%. I do have 1,000 shares in Thinkorswim and 1,300 shares in Webull, plus the 12,000 shares, plus 14,000 shares, plus those 1,500 shares in equivalent and options, times the stock at $5.88. Currently have exposure about $175,000 in the stock today, so heavily weighted towards this. Again, in the trading group, we like to be early. We like to take bold positions. I did do so today in another stock. Again, so if you guys want to check it out, link down below in the description of today's episode. But there's a lot of people that ask me, well, what should I do with my Rezolve position? Do what you want to do, dude. If you're up a lot, sell it, make it free if that makes you comfortable. If you don't care what happens in the short term, you're in this for the longer term, over the next 12, 18, 24 months, and you're comfortable seeing big upside, big downside, then hold it. If you want to sell it, sell it. Like, I'm not a financial advisor. I'm not a financial planner. I will do what I want to do, and you do what you want to do. But I think there's significant upside in the stock at this point, and that's why I continue to hold it. But let me know what you are doing with your position down below in the comment section. With that said, let's get into your broader market news today. Jobless claims. Government is shut down, so we did not get that. But what we did get today is the Challenger job cuts. Challenger job cuts came in at 54,000. The estimate, 150,000. Last month was 86,000. So this kind of offsets some of the negative jobs report from the ADP report that we got yesterday that was really bad. This says it's not nearly as bad as maybe it looked. We'll see. Challenger job cuts are planned layoffs, not actual layoffs. So there's a little bit of a difference there. But this looks good from my perspective because, again, when you're going into a recession, you do have a lot of planned layoffs, like COVID, right? Planned layoffs went crazy. If you date this all the way back, like I have before, to 2008, you started to get like 200,000+ planned layoffs before we were actually in a recession. Like it was a big red flag. Well, 54,000 beating estimates that much is a sign that maybe Wall Street was a little bit too nervous in the first place. Now, government, again, still is shut down. So tomorrow is going to be a weird day. We're going to get S&P Global Composite PMI, S&P Global Services PMI, ISM Services PMI, employment, new orders, and prices, as well as business activity. But we're not going to get non-farm payrolls, the unemployment rate, government payrolls, manufacturing payrolls, average weekly hours. We're in a little bit of a data blackout from the BLS. Now, government shutdowns historically are bullish for stocks. Historically, they're good for stocks. But again, when there's so much uncertainty what's going on out there, having this data blackout makes the Fed's job a little bit more difficult. It makes investors' job a little bit more difficult trying to sift through the noise and figure out how the economy is doing. Without the non-farm payrolls report, there's that question, how is the September jobs market? You just don't know if we don't get the data. And while that can create some uncertainty, it does likely raise the odds that we do actually get multiple Fed rate cuts from here, right? Because the risk is, we have a month or two data blackout and we start to get the data again and it's really bad and boom, all of a sudden the Fed's behind the curve, right? The Fed doesn't want to be behind the labor market curve as things are starting to look weaker. There's more of a pressure to support the labor market than to fight inflation. So the bias should be to cut rates and figure it out later once we have the information, right? The Fed's not going to pause interest rate cuts because we're not getting BLS data, right? There's more of a bias to cut rates because if we don't have the economic data. So that can be a slight offset positive. For October 29th, you're pricing in a 99.3% chance of a rate cut and a 1% chance of a 50 basis point rate cut. For December 10th, you're pricing in an 83.9% chance of another rate cut, so 2 rate cuts, and then almost a 1% chance of 3 rate cuts, and a 15.5% chance of only 1 rate cut, which is actually down from 17.5% yesterday. So even then, the longer the government is shut down, there will be some negative consequences to the labor market, to household financial positions, and that raises the odds as well of the Fed continuing to cut over the next couple of meetings. So in a weird way, it's actually exactly what Donald Trump wants. Now, in the AI investor sentiment survey that came out today, some interesting things happened. Bullish investors rose from last week. Last week, you were at 41.7%. Today, you're at 42.9%. Neutral investors fell from 19.1% to 17.9%. But look at this. Bearish investors held steady at 39.2%. The bears are holding on for dear life as the markets continue to do well. And now that we are out of that September seasonal weakness, it becomes harder and harder to make the bearish case, right? We're heading into the holidays. 2026 looks good. Big, beautiful bill. No tax on tips, no tax on overtime. With rate cuts and real estate can start to move around again. It becomes very hard in October, November, December to even have a bear thesis, right? Like, you really need to see some kind of shock on trade or some kind of shock in general to get me bearish at this point. The CNN Fear and Greed Index is at 50, which is exactly neutral. Again, that adds to my bearish thesis because you have so many bears out there. Markets are only neutral. That likely means you have room to continue higher. Market momentum is neutral. Stock price strength is greed. Stock price breadth is fear. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand and greed, and junk bond demand currently in extreme fear. If we take a look at the percent of stocks trading above their 50-day moving average, currently at 53.13%. This is pretty average for the last 5 years. You're kind of in this neutral zone. So you're not super extended to the upside. You're also not super depressed to the downside. So not much of a cue that we're getting out of that. Now, Trump touts the shutdown as an unprecedented opportunity to cut more Democratic priorities. President Donald Trump said Democrats gave him an unprecedented opportunity to slash government agencies during the government shutdown. The Trump administration recently said it froze about $18 billion for New York City infrastructure projects and canceled another $8 billion for climate projects in Democratic-leaning states. Trump said he will meet with Office of Management and Budget Director Russell Vought on Project 2025 Author to discuss cutting what he called Democrat agencies. So I do think hearing Trump say something like that, kind of being on the offensive against Democrats, likely makes Democrats probably want to fund the government and, drop some of the radical policies that they are trying to have adopted. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.